Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and the weeks ahead. This week I'm joined by Paul Robson and Brian Daingerfield, who are two co-heads of G10 FX strategy here at NatWest. It was another week where market were focused primarily on the Middle East conflict, with oil prices really driving price action. It seemed increasingly that both parties were targeting regional energy infrastructure. But Brian, I'm really keen to bring you in at this point. How are you seeing this conflict development? And at this juncture, do we see any kind of off-ramp to a de-escalation?
Yeah, thanks very much for having me, Eimear. So the market sort of continues to, I think, face a lot of volatility in terms of the direction and the path for the ongoing crisis. And it certainly feels like the market continues to trade, based on the day and based on the headlines at points with signs of optimism about potential off ramps and changes, and then at times with much more severe pessimism. And as you mentioned, I think the big development this week was escalation specifically to energy infrastructure, both the Israel strike on Iranian energy infrastructure and the counter strikes from Iran on Gulf state energy infrastructure. And so we've seen energy prices have picked up further. That's particularly true when you look at things like natural gas and Brent prices, not as much in WTI. There's been some focus here in the US on specific options that Treasury and the US could take within the WTI market and the US oil and energy market. So that spread has widened certainly, but in foreign exchange markets, I think it's super interesting because the moves in currency, certainly in the G10 space, have not been as dramatic as we've seen in recent weeks. And so in terms of the conflict itself, I think it continues to be very difficult to have a lot of visibility. And I think we see that in FX markets, where the market appears to at times trade with a more optimistic bias, at times maybe pulling back on that optimism. And I think we also see that in broad markets as well. Paul, do you want to jump in and give a couple of thoughts on where you're seeing things and how you're taking that from maybe the sort of UK European perspective for the latest in the conflict?
Yeah, happy to do that. I mean, I agree with how you set out the position that we find ourselves. It certainly feels like, relative to this time last week, we're in a more uncertain and malign environment. As you mentioned, it's been a week of seemingly escalation rather than de-escalation. Obviously, you have the fog of war, but I think markets are still struggling with a lack of a defined objective for the conflict, which makes it hard to know what the off-ramp looks like. The thing that struck me for most of the week was how keen or willing markets were to try and test to see whether we were at the point of peak pessimism. Just a couple of times they seemed to think that the off-ramp was a little bit clearer, only to be disappointed, as you say, with escalation. I thought for major currencies, the three areas that I continue to focus on are: one, central bank and government reaction functions to what's happening. See, central banks broadly as a group are just taking it a little bit slowly, cautious about wanting to know about how severe or the duration of the conflict. But ultimately, each country, each government, each central bank will be slightly different, and that will play out via currencies, I think. In terms of fiscal policy as well, the strains on government financing as yields move higher on the prospect of higher spending and maybe inflation, and to what extent individual countries have the ability to do that without causing angst in their bond markets. And the third factor, which I think is pretty well understood in these environments, is sort of terms of trade around an energy price shock. There will be some winners, there'll be some losers as well.
And Paul, on the comment about, policymakers' reaction function, we've actually just had the Bank of England, and they've had quite a market reaction. What exactly are, the gilt market reacting to?
I think it was generally a hawkish Bank of England meeting for March. I mean, you can see that through the price action, both front end rates and government yields as well, moving sharply higher. I think the initial take was the 9-0 vote in favour of keeping rates on hold. I think the consensus was 7-2. There's normally two members on the MPC who are very dovish in their views and would take a lot of shifting. And there were a couple of references in the minutes about all members ready to do what's sort of necessary to keep inflation on target. And obviously, if you have a initial inflation shock and you're worried about it being persistent, then the read across is to higher rates, not lower rates. And it wasn't that long ago, just a couple of weeks ago before the crisis, that markets were looking for a cut this week and 50 basis points of easing in total for the rest of the year. I think for currencies, for sterling and just currencies generally, it just reminds that central banks aren't born equal, and that the Bank of England has quite a lot of baggage from the inflation shock of 2022. As we spoke about this last week, we're 4 years after the European energy price shock, and service sector inflation in the UK is still 4.5%, so way above target. And that's just testament to the persistence of that initial temporary price shock. So it is important. In terms of where we go from here, NatWest economists have tweaked their Bank of England call. They no longer expect a 25 basis point cut in the policy rate this year, and they actually think that the next moving rates will be up potentially in the final quarter of this year. That could come a little bit earlier, depending on how the data play out, but they feel that the MPC will want to see some signs of second round effects creeping in. And of course, you can't wait forever, because once it gets well established, it's going to be harder to then bring inflation expectations down. But relative to market pricing for a rate hike as early as early summer, and a 50% chance that we get a hike next month, that looks a little bit too hawkish to the team here at NatWest. Moving forward, I think just interesting to see that sterling is being supported for the time being by that repricing of front-end rates. That's not unusual, but I think at this point we need to be mindful of the move in longer-term interest rates, debt servicing costs for the government, debt financing costs, because the supply of bonds is already going to be quite significant in 2026. Globally, it is. There's going to be pressure on the government to spend, whether it's on defence spending or offsetting the impact of higher energy prices if it was to persist. And what we've seen is that sterling can be negatively correlated with long-term yields. At the moment, the focus seems very much on the support from short-term yields, but I'm just very mindful and certainly watching to see whether that correlation shifts. And I wouldn't be surprised if it was to shift and that sterling struggles to hold on to its recent gains.
Yeah, that always appears to be the key vulnerability, I guess, for sterling, is that link to the long end yields. We also did have the European Central Bank today, which was partly overlooked. How are you seeing policy there, and how is it impacting the euro?
Yeah, thankfully there wasn't a huge amount of surprises actually from the ECB. The various statements and the press conference was very balanced. I think they're just cautious about the outlook. They noted the uncertainty. The one thing that central banks don't want to do is to get the market to raise rate expectations that hit economic growth unnecessarily, and so you have a hit to growth that isn't necessarily warranted. And certainly this isn't an ECB in the guise of, say, the 1990s Bundesbank, for example. They're not going at this hard. So not a lot for the euro out of today's ECB meeting, and definitely the focus more on the Bank of England and the chances of a rate hike rather than the chances of a rate hike from the ECB.
Brian, the Fed was also up this week, and it really does kind of set the pace of the monetary policy cycle for the whole world. What were your takeaways from their meeting?
Yeah, it was super interesting hearing from the Fed, especially in the context of, listening to Paul talk about the Bank of England, because, we had 8 of 10 G10 central banks held meetings this week. And they really ran the gamut between very hawkish reaction functions, and certainly there were some on the more dovish side. If I was informally ranking them, the RBA in Australia probably the most hawkish, delivering a 25 basis point rate hike, albeit a split decision. Bank of Canada probably on the more dovish side. They actually sounded a lot more cautious. Maybe it helps that they're an energy exporter themselves. I would put the Fed somewhere in the middle, maybe middle to on the more dovish side. That was my personal interpretation. Certainly the market saw it a bit more hawkish. But as I looked at what the Fed delivered on Wednesday of this week, their communications almost seemed tailor-made to send as little signal as possible about the future of policy, because they released their economic forecasts, which were largely unchanged outside of an expected increase in inflation forecast due to higher energy prices. But their assumed path, or the median path of the Fed funds rate, and the projections in the dot plot were all effectively left unchanged. There was certainly a hawkish dispersion within the individual member projections, but the Fed as a whole continues to project one interest rate cut in the median dot in 2026. And Powell himself even came out during his press conference and said, some members of the committee maybe jokingly thought that this would have been a potential meeting to skip the projections and skip the process of trying to create new projections or trying to forecast this economy because it's so uncertain. Now, I certainly have a lot of sympathy with that idea as we try and navigate these very difficult and uncertain periods with the U.S.-Iran conflict. But I think the thing that maybe markets took away from the Fed that was maybe more hawkish was 2 points, with Powell maybe saying in the first order that that the projections from the FOMC were subject to alleviation of sort of temporary or transitory, whatever you want to call it, inflation pressures from tariffs and from energy. So he sort of categorized the outlook for inflation as, we're already in the process of waiting for more evidence that tariff-related inflation in goods is going to move out of the system. And now we're layering in an inflation uptick from energy that could hit core goods as well, based on how energy and other products feed into inflation. And so we're adding another potentially temporary price shock on top of a tariff shock, which might also be transitory, moving its way through the system. And so one of the things that he said, I think the market took more hawkishly, was if we don't get the progress on inflation, we're not going to get the cut that's in the median, right? So I think the market kind of grabbed onto that. But at the same time, you just did not have this big, massive hawkish adjustment to the statement, the broad discussion. If anything, I think they kind of made the point that they seem to be pretty comfortably on hold, and different from a number of other central banks. Powell continued to stick to his point that he doesn't think the labor market is really a big source of upside pressure on inflation, that wage pressure, that the domestically generated inflation coming from wages is not really the big factor here. Instead, they're looking for, buying themselves time to make sure that the transitory or temporary impacts from, say, higher energy prices and tariffs are actually going to work their way through the system as expected. Another thing that Powell said that was interpreted hawkish was his own discussion about his future at the Fed. So one of the things he said pretty clearly was that as long as the investigation into him is ongoing, that he is not going to leave the Federal Reserve. His time as Federal Reserve chair, as chair of the FOMC, I should say, the Monetary Policy Setting Committee, will end in mid-May. But his board term extends into 2028. So his insistence was that he will stay at the Board of Governors even if his chair term lapses, as long as he is under the active investigation from the Department of Justice. And I think this is something that the market also had to internalize as something that is potentially hawkish, because you think about the future of the Federal Reserve and the incoming Fed chair, Chair Warsh, Governor Warsh, potentially coming in as soon as mid-May. When Warsh comes in, he is not currently on the board, so there needs to be another seat open for him to replace someone who is leaving the board. And right now, the seat he is potentially taking is Governor Myron's seat, who is the most dovish voice on the Fed by far, Trump's most recent appointment, because there is no other board term that's currently up. And so the math around resumption of rate cuts, a significant change around the timing of Warsh coming in, just the math around that becomes more difficult if Powell were to stay at the Fed, because I think the assumption before this was that if and when Powell decides to leave the Fed before his term is up, which is the usual pattern for when Fed governors, when Fed chairs lose their Fed chairship. This happened with Yellen as well, that she left before the end of her board term. It just complicates the math that if you replace one uber dove with who we assume is another uber dove on monetary policy in Kevin Warsh, replacing Governor Myron, it might make it more difficult for the market to internalize this idea of a Warsh premium, that Warsh will come in and drive towards lower rates. We think that view might now be underpriced. Maybe the market's underestimating the ability of Warsh to sway the committee in the dovish direction. NatWest economists still expect the Fed to resume easing in the back half of the year. That's an important consideration as we think about the long-term path of the dollar here. That's maybe a more difficult argument to make today, given everything going on. But that's how that's, I think, the couple big things that we heard from the Fed. One on policy, and then another on sort of the math at the top of the house when we're thinking about vote counting as regards to future policy and future representatives at the Fed. So maybe I'll turn here and ask you, Eimear, I want to get your views on emerging markets here, because I feel like in G10FX, I feel like there's been quite a bit of volatility. The markets are trying to internalize these different risks, and now we've heard from so many of the major central banks. We've also heard from some emerging market central banks as well. How are you thinking about all of this as relates to EM, and how have your views been changing and evolving as we've tried to internalize these recent risks?
Yeah, Brian, we've had 4 big central bank meetings in emerging markets this week. So we have Brazil, Indonesia, Taiwan, and the Czech Republic. And it was undeniable that there was a hawkish shift in policies, whether it was, reducing the scale of expected easing, or no more discussion about potential cuts, or kind of ruling out future room for easing. Policy did, shift overall on the hawkish side, but not enough to justify, the significant hawkish repricing we've had in rates markets. So we really think actually they underwhelms the market expectation. I think kind of key for me was about 3 things. So the first was, we really saw minimal increases in inflation expectations. Taiwan actually, increased its CPI projection for this year by really less than 0.2 percentage points, so minimal. Brazil, 0.1 percentage points. Actually, the Czech Republic continue to see, inflation below target. I would say the second point is all of them really pushed back against, preemptive premature rate hikes. They wanted to see how the situation in the Middle East evolved. What was also very clear is they really defended, their financial markets intervention, whether that was FX intervention in Taiwan and Indonesia, quantitative easing, which is being kind of implemented in Brazil to tame the bond market reaction. They were very clear that they had tools other than monetary policy, interest rate policy, in order to contain the financial market fallout. For me, I think they will be very reluctant to really validate what markets are pricing in terms of this, a big turn in policy outlook to a very hawkish shift. And really, from their perspective, they don't want to add any more fuel to that fire of the bond market sell-off, which obviously really complicates the situation for governments in really, financing any kind of relief for consumers, which are going to be hit by higher energy prices. I think, EM central banks have really built up this substantial arsenal of monetary policy tools aside from interest rate policy ever since COVID. And, they won't be shy about managing the financial market fallout, be it, higher bond yields or FX depreciation, via deploying those tools. Our analysis actually showed they have more of enough FX reserves on average, EM central banks have 10 times their import cover. The rule of thumb has always been 3. So we really kind of stick to our outlook that actually, the rates market is pricing in too much in terms of potential hikes or a hawkish shift. And that actually leaves, especially for those energy importers, more exposed, that they won't have rate hikes to really underpin their currencies. Because we have done a global run through of central banks this week. Thanks again for joining. And if you did like the podcast, please remember to like and subscribe so you get the latest episode first.